Welcome back to the deep dive. Today, we're going to be tackling a topic that, affects everyone, whether you're running a business, investing your savings, or just trying to, make sense of your own finances.
Right.
It's financial intelligence. You've given us some really great material to work with,
Yeah.
especially the book Financial Intelligence by Berman and Knight.
That's right. And it's really fascinating, because they argue that financial intelligence isn't just for accountants. It's like a crucial skill for anyone who wants to understand how businesses really work and make smart decisions.
I'm already intrigued. So how do they define financial intelligence exactly? It feels like one of those buzzwords that people kind of throw around.
Right.
But what does it actually mean in a practical sense?
Well, they boil it down to being able to understand how a company measures its success financially and how individual actions kind of impact that bigger picture.
Interesting. So it's not just about number crunching, but about seeing the story that those numbers tell.
Exactly. It's about connecting the dots between, different financial statements, understanding the consequences of decisions, and using that knowledge to make, smarter choices.
So for our listener today who's specifically looking to gain financial intelligence, where should we start?
Well, the foundation is understanding those core financial statements. The income statement. The balance sheet. And a cash flow statement.
Those sound familiar. But to be honest, they kind of make my eyes glaze over a little bit. Can we break them down in a way that's, actually engaging?
Absolutely. Let's start with the income statement. Think of it like a movie trailer. For a company's performance over, a specific period. It highlights the revenues.
All right.
So that's the money coming in, the expenses, the money going out. And ultimately, the profit or loss, how much money they made or lost during that time.
That's a helpful image. So is revenue just a fancy word for sales?
Well.
And if I'm looking at an income statement, are there any sneaky things I should watch out for?
Revenue can be a little more complex than just straight sales. There's this concept called revenue recognition, which dictates when a company can actually record revenue on its books. It's not always as simple as, when cash changes hands.
So say a company sells a software subscription that lasts for a year.
Right.
Do they record all of that revenue up front, even though they're providing the service over time?
That's a great example.
Yeah.
In that case, they wouldn't record the entire year's worth of revenue immediately. Instead, they would spread it out over the duration of the subscription, recognizing a portion of the revenue each month as the service is delivered.
That makes sense.
Yeah.
But it sounds like there's room for some creative accounting there. Right. Couldn't a company kind of manipulate when they recognize revenue to make their numbers look better?
You're sharp to pick up on that. That's why financial intelligence is so important.
Yeah.
You have to look critically at how a company is recognizing its revenue.
Right.
Especially if their growth seems too good to be true.
So if I'm an investor, I shouldn't just take the revenue number at face value.
Exactly. Understanding the timing and the method of revenue recognition can give you a much deeper understanding of a company's true financial performance.
Now let's move on to expenses.
Sure.
I'm guessing it's more than just adding up all the bills a company pays.
Right. There are different types of expenses.
And
understanding the distinctions can give you, valuable insights. One key distinction is between the cost of goods sold by JDS and operating expenses.
Break that down for me. What makes those two categories different?
So COGS are the direct costs associated with producing whatever the company sells. So if they made T-shirts, it would be the cost of materials, manufacturing, and labor involved in making those shirts. Operating expenses are everything else that keeps the business running. Things like salaries for office staff, rent, marketing, research and development.
So COGS are directly tied to the product.
Yes.
While operating expenses are more about running the overall business.
Precisely. And analyzing these categories separately can reveal a lot about a company's efficiency. For instance, rising COGS with flat revenue could indicate increasing material costs or manufacturing inefficiencies.
That's fascinating. I'm starting to see how understanding these nuances can help you see a company's financial picture in a whole new light.
Exactly. And there's another layer to expenses that can be tricky. Non-cash expenses.
Non-cash expense. That sounds counterintuitive. What's an example of that?
Imagine a company buys a big piece of machinery.
Okay.
They don't expense the entire cost of the machine up front, even though they paid for it.
Right.
Instead, they spread that cost over the machine's useful life,
Okay.
reflecting its decline in value over time. That's depreciation, a non-cash expense, because it's recorded on the income statement.
Okay.
But doesn't represent an actual outflow of cash at that moment.
So it's like acknowledging that the machine is losing value as it gets used,
Yes.
but it's not an immediate cash hit.
Exactly. Understanding non-cash expenses is important.
Okay.
Because it helps you bridge the gap between a company's profitability on paper and its actual cash flow.
That makes sense. You could have a company showing a profit.
Right.
But if a large chunk of that profit is tied up in non-cash expenses,
Right.
it might paint a misleading picture of their true financial health.
Absolutely.
Right.
Which brings us to the next crucial financial statement.
Okay.
The balance sheet.
Okay.
It's here where we get a snapshot of a company's financial position
Okay.
at a specific point in time.
Okay. So if the income statement is like a movie trailer,
Yeah.
what's the balance sheet analogous to?
Think of the balance sheet as a photograph.
Okay.
It captures what the company owns,
Okay.
its assets,
Yeah.
what it owes,
Okay.
its liabilities,
Right.
and what's left over for the owners.
Yeah.
Their equity.
So it's a snapshot of their financial health at that particular moment.
Exactly.
Okay.
And the key equation to remember here
Yeah.
is that assets always equal liabilities plus equity.
Can you give me some concrete examples of what falls under each category?
Sure. Assets include things like cash,
Okay.
accounts receivable.
Okay.
So that's money customers owe them.
Right.
Inventory, buildings, equipment,
Okay.
and even intangible things like patents or brand value.
Okay.
Liabilities are things like accounts payable.
Okay.
So that's money the company owes to suppliers,
Right.
loans, and any deferred revenue they've received but haven't yet earned.
And equity represents the owner's stake in the company. Right?
Precisely. It's what's left over after subtracting liabilities from assets. It includes things like common stock, retained earnings,
Okay.
which are accumulated profits,
Right.
and additional paid-in capital.
So if a company's liabilities are very high compared to their assets, that could be a red flag, right?
Absolutely.
Yeah.
It could suggest that they're heavily reliant on borrowing to finance their operations, which can be risky. And remember,
Yeah.
just like with the income statement,
Okay.
the balance sheet also involves a degree of estimation and judgment.
Okay.
For instance, how do you value a brand name or future potential earnings from a patent?
This is where the detective work comes in, right?
Exactly.
You have to read between the lines and understand the assumptions being made.
And speaking of assumptions,
Yeah.
there's another crucial concept we need to address.
Okay.
Cash flow.
Okay. I've heard cash flow thrown around a lot,
Right.
especially by investors.
Yeah.
What makes it so important and how is it different from profit?
This is a big one.
Okay.
You can have a company that looks profitable on paper,
Right.
but is actually struggling because they're not generating enough cash.
So how is that possible? Don't profits translate into cash?
Not always. Remember those non-cash expenses we talked about? Those impact profit, but don't actually represent an outflow of cash.
Oh.
And then there are timing differences.
Okay.
A company might record a sale on its income statement,
Okay.
but if they haven't collected the payment yet,
Right.
they don't actually have the cash in hand.
So it's all about the timing of when cash is actually coming in and going out?
Precisely.
Okay.
And that's where the cash flow statement comes in.
Right.
It tracks the movement of cash, both in and out of a company over a given period.
So if I'm trying to assess a company's financial health, looking at their cash flow statement is just as important as looking at their income statement and balance sheet.
Absolutely. In fact, many savvy investors,
Yeah.
like Warren Buffett,
Right.
consider cash flow to be the most important metric to look at.
I'm curious, why is that? What makes cash flow so much more reliable than profit?
It's less susceptible to manipulation.
Okay.
It tells you how much actual cash a company is generating for its operations,
Right.
which is a more tangible measure of their financial sustainability.
Okay, I'm starting to understand why they say cash is king.
Right.
You can have a fantastic product and a profitable business model, but if you're not managing your cash effectively, you're going to run into trouble.
Exactly. Understanding cash flow is essential for making informed decisions,
Right.
whether you're running a business or investing in one.
This has been incredibly helpful. We've gone over the income statement,
Yeah.
the balance sheet, and now the cash flow statement.
Right.
What I'm realizing is that these statements aren't just about numbers, they're about telling a story.
You're absolutely right.
Yeah.
And by learning to read those stories,
Yeah.
You're developing your financial intelligence, which will help you make better decisions
Yeah.
and spot potential issues before they become major problems.
Okay. I'm feeling a lot more confident in my ability to understand these basic statements.
Right.
But I know we've just scratched the surface.
Yeah.
What else should our listener know about developing their financial intelligence? What comes next?
Well, now that we have a grasp of the basic financial statements,
Right.
let's dive into the powerful world of financial ratios.
Now things are getting interesting, but before we jump into that,
Yeah.
I think it would be helpful to look at some real-world case studies.
Okay.
Let's examine some companies where a lack of financial intelligence,
Sure.
or worse,
Yeah.
deliberate manipulation led to disastrous consequences.
That's a great idea.
Yeah.
Analyzing real-world examples can really solidify these concepts and show how important it is to be financially savvy.
All right, so buckle up, because things are about to get real.
Right. Let's start with a company that, many thought was untouchable.
Okay.
WorldCom.
Okay.
They were a telecommunications giant in the late 90s and early 2000s.
Right.
But their rapid growth masked some, serious financial trouble.
What were some of the red flags that people should have noticed? If they were so big, how did they manage to hide their problems for so long?
One of the biggest red flags was their aggressive acquisition strategy.
Yeah.
They were buying up companies left and right,
Right.
often paying inflated prices and using their own stock, which was also inflated, to fund these deals.
Okay.
It created this, house of cards built on unsustainable growth.
So it's like they were trying to make themselves look bigger and more successful than they actually were.
Exactly. And to maintain that facade,
Yeah.
they resorted to, some creative accounting.
Right.
One of the most blatant tactics they used was capitalizing expenses.
Okay.
That should have been expensed immediately.
Can you give an example of what that means, in a practical sense?
Sure. One of their major expenses was line costs.
Okay.
The fees they paid to local phone companies to use their lines,
Right.
instead of recording those costs as expenses on their income statement.
Okay.
They treated them as capital expenditures, spreading those costs out over several years on their balance sheet.
So they were essentially shifting expenses from one financial statement to another to make their profits look bigger.
Precisely. And it worked for a while.
Right.
Their reported profits soared, their stock price kept climbing,
Yeah.
and investors were happy. But
Yeah.
eventually the truth unraveled.
I'm guessing this didn't end well for WorldCom.
It did not.
Yeah.
Their fraudulent accounting practices were eventually exposed,
Okay.
and they were forced to restate their earnings, wiping out billions of dollars in, fake profits.
Wow.
The company filed for bankruptcy in 2002,
Okay.
one of the largest bankruptcies in U.S. history at that time.
Oh, that's a cautionary tale if I've ever heard one.
Right.
It really highlights how important it is to look beyond the surface
Yeah.
and understand what's driving a company's reported numbers.
Absolutely. And WorldCom isn't alone.
Right.
There are plenty of other examples of companies that have used, accounting tricks to mislead investors. And often, those who fail to exercise financial intelligence pay the price.
Okay, so let's look at another case.
Okay.
What about Tyco International? I vaguely remember hearing about some scandal involving them.
Tyco's another interesting case.
Sure.
Like WorldCom.
Yeah.
They were on an acquisition spree,
Yeah.
buying up hundreds of companies in a relatively short period.
Right.
This aggressive growth strategy masked some underlying financial weaknesses. And they also engaged in, some questionable accounting practices.
What were some of the issues with their account? Was it similar to WorldCom's tactics?
There were definitely some parallels.
Okay.
Tyco also used aggressive accounting to inflate their earnings and hide their true financial position.
Okay.
One area that raised red flags was the way they accounted for their acquisitions. They often paid hefty premiums for the companies they acquired.
Okay.
And those premiums were recorded as goodwill on their balance sheet.
I remember us discussing goodwill earlier. It's that intangible asset that represents the value of things like brand recognition and customer relationships.
Exactly. And while goodwill can have real value,
Yeah.
it's also very subjective and difficult to measure accurately. This gave Tyco some leeway to inflate the value of their goodwill,
Okay.
making their acquisitions look more attractive than they might have actually been.
So it's like they were manipulating the balance sheet to prop up their reported earnings.
You got it.
Yeah.
And to make matters worse,
Yeah.
there were also allegations of executive misconduct and misuse of company funds. Top executives were accused of using Tyco's money for personal expenses,
Okay.
like lavish parties and art collections.
It sounds like a classic case of greed and a lack of accountability.
Right.
What was the fallout from all of this?
The scandal sent shockwaves through the business world. Tyco's stock price plummeted, investors lost billions,
Wow.
and several top executives, including the CEO, were convicted of fraud.
Wow. Another prime example of how a lack of financial intelligence, right,
Both within the company and among investors can have, devastating consequences.
It's a stark reminder that financial intelligence isn't just about understanding numbers.
Right.
It's about recognizing the human factors, the motivations and behaviors that can lead to both good and bad financial decisions.
Okay, for our last case study,
Okay.
let's take a look at a company that pulled off a particularly crafty scheme to inflate their revenue.
Right.
Adelphia Communications.
Adelphia is an interesting case
Okay.
because it demonstrates how a seemingly straightforward concept like revenue can be manipulated in surprising ways.
Right.
They were a cable TV operator.
Okay.
And they devised a clever way to make their revenue look much bigger than it actually was.
I'm all ears. This sounds intriguing.
Yeah.
How did they manage to pull this off?
They started charging their cable box supplier a marketing fee
No.
for using their boxes.
Hold on. They were charging their supplier for using the boxes that Adelphia was buying from them. Exactly. It seems counterintuitive, right?
Yeah.
But here's the kicker.
Okay.
They allowed the supplier to increase the price of the boxes to cover this fee. So essentially, Adelphia was just paying themselves through this, convoluted scheme.
And how did this impact their financials?
By booking this fake marketing fee as revenue,
Okay.
Adelphia was able to significantly inflate their reported sales and profits.
Okay.
It created the illusion of, strong growth and financial health,
Right.
deceiving investors and analysts.
Wow, that's a really sneaky tactic.
Right.
How long did they manage to get away with it?
It went on for a while,
Yeah.
but eventually, as with, most financial frauds,
Right.
the house of cards collapsed. Auditors and analysts began to question Adelphia's unusually high revenue growth.
Okay.
And eventually, their scheme unraveled.
What happened to Adelphia after the truth came out?
The company filed for bankruptcy in 2002, and several members of the founding family were convicted of fraud. It was a major scandal that highlighted the importance of, scrutinizing even seemingly simple line items like revenue.
Right.
And the need for skepticism when evaluating a company's financial performance.
These case studies are pretty eye-opening.
Yeah.
It seems like there's a common thread running through all of them.
Yeah.
A focus on short-term gains and a willingness to manipulate financial information to achieve those gains.
You're right. In each case, there was a lack of genuine financial intelligence, both within the companies and among those who invested in them.
Okay, so we've established that financial intelligence is crucial.
Right.
But it's clearly more than just understanding the basics of financial statements.
Yeah.
How do we move beyond the basics and develop a deeper understanding of a company's financial health?
Right.
What tools and techniques can we use to really dig into the numbers?
That's a great question.
Yeah.
And it leads us to the fascinating world of financial ratios.
Now, things are getting interesting,
Yeah.
but I've heard of financial ratios. But to be honest, they've always seemed a bit intimidating.
Right.
Can you break them down in a way that's understandable and, dare I say, even interesting?
Absolutely. Financial ratios are essentially calculations that help you compare different pieces of financial information, revealing relationships and trends.
Yeah.
They can tell you a lot about a company's performance, efficiency, and risk.
Okay, so they're like financial detectives.
Yeah.
Helping us uncover the hidden stories within the numbers.
Exactly. And the beauty of ratios is that they can be used to compare a company's performance over time, to compare it to its industry peers.
Okay.
And to benchmark it against its own goals.
I'm starting to see how powerful these ratios can be. So where do we begin? Are there specific types of ratios we should focus on?
There are many different types of financial ratios.
Okay.
But we can group them into 5 main categories.
Okay.
Profitability ratios.
Okay.
Leverage ratios. liquidity ratios,
Okay.
efficiency ratios, and working capital ratios.
Okay. That seems manageable.
Yeah.
Let's start with profitability ratios.
Yeah.
What can they tell us about a company?
Profitability ratios, as you might guess,
Yeah.
measure a company's ability to generate profit.
Hmm.
They reveal how effectively a company is using its resources to generate income.
Okay.
Some of the key profitability ratios include gross profit margin,
Okay.
operating profit margin, return on assets, and return on equity.
Let's break those down one by one.
Sure.
What is gross profit margin and why is it important?
Gross profit margin is calculated by dividing gross profit by revenue.
Oh,
Gross profit is what's left after subtracting the cost of goods sold from revenue.
Hmm.
This ratio tells us how much profit a company makes for every dollar of sales,
Okay.
after deducting the direct costs associated with producing those goods or services.
So if a company have a high gross profit margin,
Yeah.
it means they're keeping a larger chunk of their revenue
Right.
after covering the costs of making their products.
Exactly. It suggests they have good control over their production costs
Okay.
and or strong pricing power.
Hmm.
A declining gross profit margin, on the other hand,
Yeah.
could be a warning sign that costs are rising,
Right.
competition is increasing,
Okay.
or the company's having to lower prices to maintain sales.
That makes sense.
Yeah.
Okay, what about operating profit margin?
Hmm.
How is that different from gross profit margin?
Operating profit margin takes a broader view of profitability.
Okay.
It's calculated by dividing operating profit by revenue.
Mm-mm.
Operating profit takes into account not only the cost of goods sold,
Right.
but also operating expenses like salaries, rent, and marketing costs.
So it gives us a more comprehensive picture of a company's profitability
Yes.
by factoring in all the costs of running the business.
Precisely. A healthy operating profit margin indicates that a company is effectively managing its overall costs
Okay.
and generating profit from its core operations.
These margins are starting to make sense to me. Let's move on to return on assets, ROA.
Okay.
What does this ratio tell us?
ROA measures how efficiently a company is using its assets to generate profit. It's calculated by dividing net income by total assets.
Okay.
Essentially, it tells us how much profit a company is generating for every dollar invested in its assets.
So a company with a high ROA is making good use of its resources,
Yeah.
whether those resources are factories,
Right.
equipment, or even intellectual property.
Exactly. A higher ROA is generally a sign of efficiency and effective management.
And finally, for profitability ratios, we have return on equity, ROE.
Okay.
How is ROE different from ROA?
ROE is similar to ROA,
Okay.
but focuses specifically on the return generated for the company's owners, the shareholders.
Okay.
It's calculated by dividing net income by shareholder equity.
So it's a measure of how effectively the company is using the money invested by its owners to generate profit.
Precisely.
Yeah.
ROE is a key metric that investors look at
Yeah.
to assess the potential return on their investment.
These profitability ratios are starting to paint a clearer picture for me.
Good.
But I'm guessing profitability is only part of the story, right?
Absolutely. To get a truly holistic view of a company's financial health,
Right.
we need to explore other types of ratios, such as leverage ratios,
Okay.
which tell us about a company's debt levels and financial risk.
Okay. Let's dive into those next. I'm ready to learn more about how to use these ratios to become a financial detective.
All right.
All right, let's talk leverage ratios.
Up.
I know that debt can be a good thing for companies,
Right.
allowing them to invest and grow.
Uh-huh.
But too much debt can obviously be dangerous.
Right.
So how do we use ratios to kind of assess that risk?
That's right. Debt is a double-edged sword.
Yeah.
Leverage ratios help us understand, how much debt a company is using and whether they can handle it.
Okay.
One of the most common leverage ratios is the debt-to-equity ratio.
Okay, debt to equity. I've heard that term thrown around. But what exactly does it measure?
It's pretty straightforward. You divide a company's total debt by its shareholder equity.
Okay.
This tells you what proportion of the company's financing comes from debt compared to equity.
Right.
A higher ratio means they're using more debt to finance their operations.
So if a company has a debt to equity ratio of 2,
Yeah.
that means they have twice as much debt as equity.
Exactly. And while some debt can be healthy,
Right.
a very high ratio can be a warning sign.
Okay.
It might mean they're over-leveraged and vulnerable to, economic downturns or rising interest rates.
What about the interest coverage ratio? How does that factor into the debt picture?
So the interest coverage ratio tells us how easily a company can cover its interest payments on its debt.
Okay.
You calculate it by dividing earnings before interest and taxes, EBIT, by interest expense.
So if a company has an interest coverage ratio of 5,
Yeah.
it means their earnings are 5 times greater than their interest expense.
Precisely.
Okay.
A higher ratio indicates they have a bigger cushion to cover their interest payments. Okay.
Which is generally a good sign.
These leverage ratios definitely seem important for assessing a company's, risk profile.
Yeah.
Okay, what's the next category of ratios we should look at?
Let's talk about liquidity ratios.
Okay.
These focus on a company's ability to meet its short-term obligations.
Short-term obligations meaning things like paying their bills and suppliers.
Exactly.
So liquidity is all about having enough cash on hand
Right.
to keep the lights on.
Exactly. 2 key liquidity ratios are the current ratio
Okay.
and the quick ratio.
What's the difference between those two? Don't they both kind of measure the same thing?
They both give us a sense of a company's short-term financial health,
Right.
but the quick ratio is a bit more conservative.
Okay.
It excludes inventory from current assets.
Okay.
Because inventory can sometimes be difficult to sell quickly.
So the quick ratio focuses on the most easily accessible assets.
Right.
That makes sense.
It gives you a clearer picture of a company's ability to meet its immediate obligations.
Without having to rely on selling off its inventory.
Okay, moving right along, what about efficiency ratios?
Oh,
What do those tell us?
Efficiency ratios are all about how effectively a company is using its assets to generate sales.
Hmm.
One key ratio here is inventory turnover,
Oh,
which tells us how quickly a company is selling its inventory.
so a higher inventory turnover means they're selling their products quickly and not letting them sit around gathering dust?
Exactly. A high turnover is generally a good sign,
Okay.
especially for companies that sell, perishable goods or products that become obsolete quickly.
Right.
It means they're managing their inventory efficiently
Mm-hmm.
and not tying up too much cash.
Are there any other efficiency ratios we should be aware of?
There are several, but another important one is total asset turnover,
Okay.
which gives you a broader view of how effectively a company is using all of its assets to generate revenue.
So it's like a measure of how much bang they're getting for their buck
Yeah.
from all of their resources.
You got it. And finally, we have working capital ratios.
I remember us talking about working capital earlier.
Right.
It's basically the difference between a company's current assets and its current liabilities, right?
That's right. And working capital ratios help us understand how effectively a company is managing this, crucial aspect of their finances.
So what are some examples of working capital ratios?
One is days sales outstanding,
Yeah.
DSSO,
Okay.
which measures how long it takes a company to collect payment from its customers.
Yep.
A lower DSO is generally better,
Right.
indicating that they're collecting their receivables quickly and efficiently.
Okay.
Another important one is days payable outstanding, DPO,
Okay.
which measures how long it takes a company to pay its suppliers.
So with DPO, a longer period could actually be a good thing, right? It means they're holding on to their cash longer.
That's true, but there's a trade-off.
Okay.
While extending their payment terms can be beneficial for their cash flow,
Right.
it can also strain relationships with suppliers if they're waiting too long to get paid.
Wow. We've covered a lot of ground with these ratios. It's
Yeah.
amazing how much insight you can gain by analyzing these, different financial metrics.
Right. And the key is to use them in combination with each other and with your understanding of the company's overall business and industry.
So financial intelligence is like putting together a puzzle, using all of these pieces of information to get a clearer picture of the whole.
Exactly. And the more pieces you have,
Right.
and the better you understand how they fit together,
Yeah.
the better equipped you'll be to make, smart financial decisions.
Well, this has been a truly enlightening deep dive into the world of financial intelligence.
Good.
We've explored the key financial statements,
Yeah.
delved into the fascinating world of ratios, and examined real-world examples of how both financial savvy and financial mismanagement can have a huge impact.
It's been a great discussion.
I think the biggest takeaway is that financial intelligence isn't just for, finance professionals.
Yeah.
It's a crucial skill for everyone, whether you're running a business,
Yeah.
investing your hard-earned money,
Right.
or simply trying to make sense of your own finances.
I completely agree.
By developing our financial intelligence,
Yeah.
we can empower ourselves to make informed decisions,
Right.
spot potential risks, and ultimately achieve greater financial well-being.
And remember, financial intelligence is a journey. not a destination.
Hmm.
There's always more to learn, and the world of finance is constantly evolving.
Right.
So keep exploring, keep asking questions,
Yeah.
and never stop seeking out new knowledge and insights.
Thanks for joining us on this incredible deep dive into financial intelligence.
Absolutely.
We hope you've enjoyed the journey and are inspired to continue exploring this fascinating and essential field